Stock Market Money Management, the Smart Investor's Guide. Managing your money in the stock market is just as important as picking the right stocks. Even the best stock picks can lose you money if you don't manage your capital wisely. In this video, we'll cover the key principles of stock market money management that every investor should know. Rule number 1. Never risk more than you can afford to lose. Before you invest a single dollar, ask yourself, can I afford to lose this money? The stock market is unpredictable. Prices go up and prices go down. A golden rule is to never invest money you need for rent, groceries, or emergencies. Only invest your surplus, money that won't impact your daily life if it disappears tomorrow. Rule number 2. Build an emergency fund. First, before you invest, make sure you have 3 to 6 months of living expenses saved in a separate liquid account. This prevents you from being forced to sell your investments at a loss during a personal financial crisis. Rule number 3. Diversify your portfolio. Don't put all your eggs in one basket. Spread your investments across different sectors: technology, healthcare, energy, finance, and consumer goods. When one sector drops, others may hold steady or rise. A well-diversified portfolio reduces your overall risk significantly. Rule number 4. The 1% risk rule. Professional traders use this rule religiously. Never risk more than 1% to 2% of your total portfolio on a single trade. For example, if you have $10,000 invested, risk no more than $100 to $200 on any single position. This way, even a string of losses won't wipe out your account. Rule number 5. Use stop-loss orders. A stop-loss order automatically sells your stock when it drops to a certain price. This removes emotion from the equation. For example, if you buy a stock at $50, you might set a stop loss at $45, limiting your loss to just 10%. Always know your exit point before you enter a trade. Rule number 6. The 50-30-20 investment framework. Think of your investable money in 3 buckets. Put 50% into safe, long-term investments like index funds or blue-chip stocks. Put 30% into growth stocks with higher potential but more risk. And keep 20% in cash or cash equivalents so you can take advantage of opportunities when the market dips. Rule number 7. Reinvest your dividends. If you own dividend-paying stocks, reinvest those dividends instead of cashing them out. Over time, this compounding effect dramatically grows your wealth. A $1,000 investment reinvesting dividends over 20 years can be worth significantly more than the same investment without reinvestment. Rule number 8. Avoid emotional trading. Fear and greed are the 2 biggest enemies of a successful investor. When the market crashes, fear pushes people to sell at the worst time. When the market is booming, greed pushes people to buy overpriced stocks. Stick to your plan. Make decisions based on data, not emotions. Rule number 9. Review and rebalance regularly. At least once every 3 to 6 months, review your portfolio. If one stock or sector has grown too large, say it now represents 40% of your portfolio, it's time to rebalance. Sell some of the winner and redistribute into underweighted areas to maintain your target allocation. Rule number 10. Keep learning. The market constantly evolves. New industries emerge. Economic cycles shift. The most successful investors never stop learning. Read books, follow market news, study financial reports, and always be willing to adapt your strategy. final thoughts. Money management is the foundation of successful investing. You don't need to be a Wall Street expert to build wealth in the stock market. You just need discipline, patience, and a solid plan. Start small, stay consistent, and let time work in your favor. If you found this video helpful, like and subscribe for more practical investing tips. And remember, the best investment you can ever make is in your own financial education.